Do you have an interest in gender in the workplace and an interest in finance? If the answer is yes, then you might be interested in the impact of mutual fund manager gender on investor capital allocation. Let's delve into this topic by starting with a discussion on gender. Women have long outpaced men in educational achievements, but it would take another 80 years for women to achieve economic parity with men, according to the World Economic Forum. That's right, 80 years. That's a long time. And economic opportunities for women lag behind those for men by 20%, even in the most gender equal nations. So now you might be asking yourself, why is this important? Well, besides the philosophical importance of gender equality, there are in fact economic benefits. Achieving gender parity in workforce participation rates would actually increase the GDP of developed nations by 12% and by an even larger percentage in developing markets. In the financial sector, women are notoriously underrepresented compared to other fields. In healthcare, 37% of doctors are women. In law, 33% of lawyers are women. In accounting, 63% of accountants are women. Now moving to finance, investment banking actually has 23% women. Real estate private equity has 12% women. Meanwhile, venture capital has 11% women. Mutual funds, in terms of managers, have 10% women. Buyout funds have less at 7%. And hedge funds have only 3% women. Here, we're going to focus on mutual funds. Within this space, there is clearly a lot of inequality, and that inequality is potentially problematic. So now, let's delve into some research and some definitions. To start, a mutual fund is an investment program funded by shareholders that trades in diversified holdings and is professionally managed. So here, what we're interested in knowing in terms of mutual funds is, do investors discriminate based on the gender of the fund managers when they give money to mutual funds? Past research has been done on this question. Which gender performs better? Who is more skilled? Is there discrimination? According to Jones, females outperform men. Female funds returned about 10%, while male funds returned only about 6% in 2013. And between 2007 and 2013, female funds returned 6%, while male funds actually lost money, and the S&P 500 returned 4.2%. This shows that females might be outperforming males, but this study was highly flawed. Actually, female funds are much smaller than male funds, and that's important to note because that makes it a tough comparison. Another study, looking at US funds, showed that funds managed by women outperform those managed by men with less risky portfolios. But that result doesn't necessarily hold in all other studies. One study by Bablos and another study done by Agarwal showed that there was actually no difference between gender in terms of mutual fund performance and skill. Looking at all these studies together, there's so much conflicting evidence. Who performs better? Is there discrimination? How should we be understanding this question? So, how does this research fix all of that? What's different? Well, this research uses a different frame, and it is a frame that is based on the work of Burke and Van Binsbergen in 2015. So, how does this research intend to show discrimination between males and females in mutual funds? Well, we need to look at net alpha and value added. Net alpha is the abnormal returns after the subtraction of management fees, and value added is the amount of money added to the economy, or gross alpha times fund size in this case. Other studies have used returns or gross alpha to understand skill or performance, but we think that's flawed. So why is that flawed? Let's look at an example. In this example, we have manager A and manager B. Let's assume that these two managers are equally skilled, meaning that they have equal gross alpha, but only under the condition when they are given equal amounts of money to invest. Further, let's assume that as we increase the money the manager gets, the actual investment ideas the manager has will decrease with decreasing returns to scale. So, there's manager A and manager B. Let's assume that at $100 million, both managers will have gross alpha of 1%. And if we add another $100 million to make their fund size $200 million, their gross alpha will drop to 0% for that extra $100 million. In terms of fees, let's assume that manager A charges a 1% fee, while manager B charges a 0.5% fee. And we must assume that net alpha must be 0 if we have perfect competition, as investors keep giving money to the best manager. For this net alpha of 0 to occur, gross alpha, in this case, must be equal to the fees, which puts A at 1% and B at 0.5%. So manager A would have a fund size of 100 million to get that gross alpha of 1%, and manager B would have a fund size of 200 million to get that gross alpha of 0.5%. Through this example, we can see that value added, gross alpha times fund size, is equal for both managers to the compensation, which for both managers is 1 million. Indicating that value added is a reliable measure of skill even when gross alpha is not equal and when the fund sizes are not equal. Value added is still the same and the best measure of skill. In general, managers need to prove themselves with high alpha to attract investors, and those managers with the highest alpha should continue to receive more investments until the most skilled managers have large funds in a space with much competition between highly skilled managers. According to this example and according to theory, this must be true. It makes sense. However, there's times when this isn't true. And what's an example? If there's discrimination with fund allocation. This graph shows value added in red and alpha in blue and has the potential to show systematic discrimination. With the same alpha line, two managers can have the same skill potential but different value added, showing that investors could be discriminating in terms of capital allocation to different yet equally skilled managers. The optimal value added is the max value added. If there is a manager that lies on the left of the max point with suboptimal value added, those managers are not getting the optimal capital allocation for their performance under efficient markets. If females are significantly exhibiting suboptimal value added, while males are exhibiting optimal value added, there might be a systematic discrimination in the markets that impedes females from receiving the proper capital allocation from investors. So, this is the theory, and how do we test it with data? To test it, we need two null hypotheses. Number one, females are equally as skilled as males when it comes to fund management in terms of potential value added. And number two, investors do not have institutional bias between males and females, implying that when they allocate capital to candidates who have the same skill and charge the same fees, those candidates will get the same capital. So now, how do we test these null hypotheses? What data do we need? We need data on gender, data on gross alpha, we need the fund's management fees, and we need to understand the fund size. And then we need to calculate and compare net alpha and value added between male and female funds. This data was acquired from the Morningstar database, which resulted in information on 5,000 funds. Now, compared to the whole universe of U.S. mutual funds, 5,000 is actually a very small number, and that's important to know. Now, to calculate gross alpha, we used the returns from Morningstar, as well as risk-free rates and the market premium between the years 2006 and 2016. This calculation yielded 780 data points after the need to exclude certain funds for the lack of data. Gender was found using LinkedIn and other web sources based on fund manager name given by Morningstar. And the management fees and the fund size were already given directly through the Morningstar database. And now on to statistics. This study ran t-tests to compare net alpha and the value added between males and females. With this, there were 9 possible outcomes, each indicating a different result. A higher net alpha in one gender would indicate that that gender was not allocated capital properly. That group should be given more money to best extract value. So higher net alpha means potential discrimination by investors. A higher value added in one group may mean higher scale unless capital was not properly allocated due to that higher net alpha. So the group was not able to showcase its skill through the metric of value add. So how do these scenarios line up with what actually occurred in the data? Which scenario, in fact, is the answer? So, what are the results of the study? The study found that female funds saw a statistically significant higher net alpha than male funds, with a female mean of 7.0% and a male mean of 5.27% and a very statistically significant p-value. Additionally, female funds had statistically significant higher value added when compared to male funds, again with a very statistically significant p-value. So the higher net alpha shows females are not given enough capital, and the higher value added shows that females have higher skill. This indicates possible discrimination, even though these females are able to extract such high value added when they're not given enough money, showing very high skill according to the data. However, there are caveats, and the study had many challenges. First, only 10% of mutual fund managers in the United States are women. Finding a sufficient sample for the sufficient number of females within a proper time frame proved challenging, especially since many of these women manage funds with a team of men. It's unclear if females are extracting higher value added or if it is a combination of males and females that creates high skill. Second, there's a self-selection bias of women. The results of this study show that females have higher skill than men, but that can't be generalized as a gender outcome. It cannot be the takeaway that females as a gender are better at investing. It is just these managers. Given the industry, it is the highest skilled of females that are fund managers, since there are so few of them. And third, 5,000 funds is really too small a sample size because the actual universe of mutual funds in the US is at least 5 times larger. Perhaps if data could have been obtained for all US mutual funds, the results would have been more comprehensive and could more fairly represent the industry. So there's a lot of opportunities for more research. That future research could hopefully include more mutual funds that would be a better representation of the mutual fund universe, and it would have a clear way to define female funds. Additionally, interviews with fund managers and investors could give a great qualitative and holistic perspective on this question. Before we end, I'd like to thank Dr. Van Binsbergen and Dr. Shermans for all their support during this research. Here are my sources and references. Thank you for watching.